Scene script. Imagine waking up to news that the world as you know it is on the brink of economic collapse. That was the reality in 2008 when the financial crisis gripped the globe. But what exactly set off this financial tsunami that erased trillions of dollars of wealth? At the heart of the turmoil was a significant drop in the gross domestic product, commonly known as GDP. This decline was not just a dry statistic. It was a domino that tipped over many others, leading to a crisis that affected millions of lives. As GDP began to falter, businesses sensed a storm brewing. They faced a harsh reality. As economic growth slowed, so did their sales. The natural response was to cut costs, which often meant layoffs or halting wage increases. This reduction in workforce and stagnant wages meant that many families found themselves earning less than before. With less money coming in, the dreams of home ownership became nightmares for many. Mortgages, once thought of as symbols of stability, turned into financial shackles. As incomes shrank, even those who had initially secured affordable mortgage rates found themselves struggling to meet monthly payments. This was particularly painful as adjustable rate mortgages reset at higher rates, further straining household finances. The impact of lower incomes was straightforward. People couldn't spend as much. This drop in consumer spending hit the economy hard, creating a feedback loop that further suppressed GDP. Retailers ordered less stock, manufacturers slowed production, and businesses continued to cut jobs. The housing market, already teetering from an influx of bad loans and speculative buying, couldn't withstand the additional pressure. As more people defaulted on their mortgages, a wave of foreclosures swept across the nation. This not only displaced families but also led to a surplus of homes on the market, causing house prices to plummet. This crash in home values had a ripple effect. Financial institutions that had heavily invested in mortgage-backed securities found themselves holding worthless assets. The collapse of these assets strained the banks, leading to a credit crunch. Businesses couldn't borrow money, consumers couldn't get loans, and the economic gears ground to a halt. Lehman Brothers, a giant in the financial world, became a symbol of the crisis as it filed for bankruptcy in September 2008. This event marked a turning point, showing just how interconnected and fragile the financial system could be. Governments around the world stepped in, attempting to stabilize the market through bailouts and regulatory reforms. These actions, while controversial, were deemed necessary to prevent a total economic meltdown. In summary, the drop in GDP during the 2008 financial crisis had a cascading effect that led to lower incomes and a subsequent mortgage crisis. This economic downturn not only affected financial markets but had a real and profound impact on individuals and families across the globe. Understanding these connections helps illuminate not just the causes of past crises, but also underscores the importance of vigilant economic policies and practices to prevent future collapses. The lessons of 2008 remain crucial as we navigate the complexities of today's global economy.